Susan, good morning. One reason I'm looking for the market to correct downward is because we have had such a big run-up in equities so far. In my opinion, the push-up in terms of equity prices has come mainly due to the stimulus from the monetary side. And we heard, for instance, Olivia talk a minute ago about how Bill Dudley, the head of the New York Fed, made a statement about the continuation of the Fed's stimulus program. So in other words, whenever the market corrects a little bit, the Fed comes out and says they are going to provide more stimulus. But the reason for my concern about the equities is that there is an increasing divergence between the economic fundamentals, which still show a lot of weaknesses, and compare that with the monetary stimulus, which is making you want to go and buy equities. At some point in time, the divergence becomes excessive and the market starts to correct. It's very hard to give the timing, but the more you run up, I think the greater the fall needs to be to compensate for that. In other words, Susan, I'm saying the rotation from fixed income to equities hasn't quite begun yet.
Okay, but you're saying that you're expecting a 15% drop in U.S. markets till year's end. You're saying don't invest in emerging markets. It's not the time to do that just yet. So where do I go if I'm an investor?
What you're doing is that the overall situation, bonds, I'm being optimistic. I think we saw the rally in bonds to some extent. We went to 262, 263 on the 10-year. We have come down to below 250 this afternoon in New York. My expectation is that the bond market would continue to rally because of the economic weakness, because of developments in Europe. And particularly, my concern is on the Japanese side because they have a lot of stimulus but very little in terms of structural reform, Susan. And that means if there is also a Japan risk of flight from the Japanese yen, a flight from JGBs, and if that happens, the U.S. bonds benefit as well. So that's one area to be in. Second, the dollar is king. I've been saying that on your programs in the past. We saw the euro come down below 130 today with the dollar. The expectation is either in the Thursday meeting of the European Central Bank or sometime soon, we are going to see rate cuts by the ECB. And even as the U.S. is talking about cutting back on the bond purchases, the European Central Bank is going to tighten. So what that means is that shorting the euro is going to be good business. Essentially, we are looking on the U.S. equity side to perform better than the rest of the world. So while I'm negative overall on equities, I still like defensive equities, consumer staples, utilities, high dividend stocks. These are among the places for an investor to be at this time.
Okay. Well, in the past, you also predict a double dip into recession for the U.S., but right now the concern is from the emerging space. I mean, Brazil's stock market is at its lowest in 4 years. There could be a recession in Brazil, which is a huge emerging market. Concerns about China's growth. Do you think this could be the next risk phase for global markets coming from the emerging space?
The emerging markets are already proving to be a risk for the global economy. You're spot on that, Susan, and I think that's going to continue for some period of time. And Europe is the one which is the sleeper. We have seen the recession continue. A few hours ago, the Eurozone said that the unemployment rate was revised up to 12.1%. By all means, a major record forever. My expectation is that the recession is not going to be easy to get over until some of these countries get a reduction in the level of debt. So the recession is quite severe in Europe as well, which is one reason, going back to the point you made about my double dip recession in the U.S., I can't see how the U.S. can continue to grow when the rest of the world is all going to slow down or go into recession. We saw the Goldman Sachs forecast in terms of pull down, in terms of the rate of growth in the U.S. economy. Others have been doing that as well. Here you have a plane which is just unable to get to the 30,000-foot level to fly. It is still at a 5,000-foot level. I refer to the U.S. economy, despite the fact we have 4 years since the economic recovery began. That increases my concern about the weakness of the U.S. economy, Susan.